Top 5 worst stocks ever. Welcome in, guys. I am Jeremy. This is a financial education channel, and today we're talking about top 5 worst stocks since I've been invested. There's 2 requirements for today's video. One's got to be stocks that since I started investing, stocks that I saw and they were so overvalued, and I saw the trend coming and I was just looking at them. I'm like, this stock is so far overvalued, guys. So that's the first one. It's got to be stocks that since I started investing I saw. The other thing I did for this is I made sure they're all popular, well-known companies. All 5 of these stocks, they're not some obscure stocks. These are stocks that you guys have probably know of and have heard of and whatnot. To achieve in today's video is basically that you guys can spot trends in the future, because a lot of these trends that these 5 stocks had, a lot of stocks today have some of these trends, okay? Or are gonna have some of these trends in the future, and you're gonna be looking into a company that's got some of these exact same trends going on that these 5 stocks had, and all 5 of these stocks have fallen massively since they went up really high, guys. So hope you enjoy this today. Make sure after today's video is over, you click that very first link in the description. That's to join my exclusive private stock market membership group. We are at 99 members. You have a chance to be member 100, guys. That is really cool. We're about to hit 100 members on there. That group goes into all stocks I'm buying and selling and why, stocks I'm looking at, entry levels I'm looking at, entry prices I'm looking at, exit prices I'm looking at, as well as also it has a 12-part, full-part stock options course, which every single investor out there needs to know stock options, guys. So make sure you join there after today's video is over. Let's get into this. All right, guys, coming in at number 5. Coming in at number 5 is a very popular fast casual restaurant chain. One of the hottest stocks going into 2014. It was one of the hottest restaurant stocks I've ever seen, certainly in my time and possibly ever, guys. This was a company that was trading in the tens of billions of dollars as far as the market cap went. They were just growing and growing. Their burritos are massive. And what is it? Chipotle. Coming in at number 5, guys, is Chipotle. This stock was set up for failure. Chipotle was set up for failure here at number 5, guys. The issue with Chipotle was this was a restaurant chain, okay? A fast casual, wannabe Mexican, restaurant chain. Well, the hottest restaurant chain out there, okay? And the issue was this company was so far overvalued as far as the PE ratios went for this company. This stock was priced to perfection, okay? This stock was priced to perfection. They had unreal, comp store sales. They were growing them 4, 6, 8, 10% comp store sales. They were amazing. Revenues were exploding. Profits were going up, but they weren't going up at a ridiculous rate, okay? If you really look at Chipotle's profits compared to the revenue was actually much more impressive, and the comp store sales were actually much more impressive than the bottom line. That's because they were expanding so fast. They were opening up a lot of restaurants and whatnot, all right? So this was such a hot chain, and they had other businesses they were kind of possibly going into. They had something called Chop Shop, which was kind of like a Chipotle but for Asian food. Okay, so it looked like that could be maybe the next big thing. Maybe they could have someday 1,000 of those type of restaurants, right? And this could be a massive Goliath company, kind of like a Yum Brands but for a little higher quality food, right? Yum Brands, by the way, they own chains like Taco Bell, Pizza Hut, KFC brands like that. So that it almost looked like Chipotle could be the next one of those, just a little bit higher tier food, you know? And this stock was set up priced to perfection, guys. The PE was astronomical in this company. And then what happened, the whole E. coli situation happened. They had another norovirus or something going on there. It was thing after thing going wrong with Chipotle. And this stock was over $700. And now this stock, less than 3 years later, is trading somewhere around $275, guys. This stock was over $700. Now it's around a $270, $275 stock. Chipotle is, and it was a stock that was literally priced to perfection in the restaurant space. Since that time, they had that disaster that happened in Chipotle. They've done, in my opinion, a pretty good job as far as saving the whole company, as far as not going under or something like that. They actually did a really great job as far as that went. But they've also exited the shop house business, and they kind of have a few other businesses they might try to get into, a little pizza game, little burger game. But right now, it just looks like Chipotle is just kind of the way they got to focus right now, and they've also cut down on the amount of restaurants they're going to be opening now. So it's just bad news and bad news around Chipotle right now. And it's just a stock that I saw that was just massively overpriced because of how many years it would take them to get that PE to a realistic range. It would have took them at least 5 to 10 years to get that PE to a realistic range if that stock price stayed the same, because their net income was way lagging compared to where they were at, guys. And so you got to always be paranoid if you're in a restaurant chain that's got a PE in, let's say, the high, 80s, 90s, or even the hundreds that Chipotle has at some points, right? In the hundreds, you got to be prepared that, man, if something happens like that, this stock could be, literally cut in half, if not cut by 75% overnight, guys. And that's pretty much what's happened to Chipotle here. That's why it comes in at number 5. Does anybody remember a super popular game called Farmville? What about Mafia Wars? Well, in the late, let's say 2007, 2008, 2009, maybe even into 2010, if you were on Facebook, I can almost guarantee you know about Farmville, you maybe played it. You know about Mafia Wars, you maybe played it. You know about those games. They were all over Facebook, and you get 1,000 requests a day from people saying, hey, I need a cow or something like that on this Farmville game, guys. It was blowing up. It was raking in the revenue, and the owner of that company, they went public around 2011. It was 2010, 2011, and their name was Zynga. Zynga. And this was a stock that priced, the IPO was somewhere around, I believe it was $15, right? Now this stock trades in the 3s, all right? Huge difference in the business. This is a stock that traded at a ridiculous valuation compared to the amount of money they were bringing in. But it wasn't just that. In this particular time when they were going public, like I said, it was around, I think, 2011 they went public, right? That was a time when we were shifting more from PCs to mobile. And it was like, okay, how is this going to change things? And Facebook was changing a lot at that time. And they were changing more to a mobile format because people were starting to buy a lot of smartphones, right? Smartphones were starting to be used more and more. And this was totally changing the way people interacted from Facebook just being on a PC and maybe playing a Farmville game on there to all of a sudden now they were not, okay? And so it was up to Zynga to kind of change the business into a mobile format and try to get apps and whatnot. And they absolutely failed at that. They absolutely failed. They still, to this day, do not even have a big time game in the app wars. They lost that war to a company that came out of nowhere, which was Supercell. They started a game called Clash of Clans. Then they started Boom Beach. They got several games, Clash Royale. And they also lost to King Digital, which took a ton of its female customers away by a game called Candy Crush, okay? And several other games they had, but Candy Crush was the main one. And so those type of companies ended up dominating the mobile apps, while Zynga, which was kind of thought to be maybe they could be the future game leader out there, they were kind of forgotten about. And that's why that stock still to this day is somewhere around a $3 stock. They made so much money in the IPO that it was literally billions of dollars they got in the IPO that has literally funded the business to this day, and they're still able to stay afloat mainly because of all the proceeds they got from that huge IPO. Because when they went and did the IPO, it was like the biggest game, I believe it was the biggest gaming IPO ever in the history, guys. So that's just a stock you got to watch out for that, guys. When there's a huge trend shift that's happening there, you got to wonder, can this company change with the trend, which was, okay, we're going from PCs, and then also Facebook's kind of changing the way they're doing things a little bit. Now we're going to a more apps dominated world. Are they going to be able to shift that way? And some investors thought they could, and they were wrong, unfortunately. Some investors didn't, and they stayed away from Zynga, guys, and that's why it comes in at number 4. Man, Apple's a hard company to compete with. This next one, guys, coming in here at number 3. This one of the main reasons this one has gone down so much from where it was trading at is honestly because of Apple and Samsung. And whenever Apple or Samsung comes in your space, I think you just have to pay attention to that, guys. They're very hard companies to beat, specifically Apple. And which company am I talking about? I'm talking about Fitbit, guys. We're talking about Fitbit. This was a company that IPO'd, it was somewhere around, it was IPO'd in the 20s, shot up within probably 6 months to a year after that. It was in the 50s, right? It was in the 50s, and this was just a couple of years ago. Now the stock's about a $6 stock, okay? So it went from $50 to $6 now in literally a couple of years' time. Now, what Fitbit had going wrong for it it actually never had a super astronomically high PE, okay? It did have a high PE as far as relative to the market, but it wasn't like, oh my gosh, it's trading in the thousands or the hundreds or something like that, okay? So that actually wasn't the issue. The issue with Fitbit came down to who was coming in their space, okay? And who came in their space? Apple. A few years ago, Apple launched the Apple Watch, okay? That did many of the same things a Fitbit did, but also it did even more, okay? And Apple has the brand power that they can just, when they really want to focus on something, it's very hard to compete with them. And that's the issue Fitbit's had. And since then, Fitbit sales have been declining. Also, they've had to take a lot of write-offs at retailers and things like that, guys. So they capitalized on the huge wearable trends, but now they're kind of facing the brunt of, oh, the big dogs wanting to come in and take some business out of that, which is Samsung, because Samsung has several different wearables, and then Apple, with how much Apple has focused on the Apple Watch of late, guys. And I can honestly tell you, at least in my own personal life, I know way more people that wear and actually have an Apple Watch than they wear a Fitbit, and some of them used to have Fitbits, but now they wear an Apple Watch full-time, guys. So for that reason, Fitbit comes here at number 3, guys. They just had huge competitors coming into their space, and it's hard to compete with those guys when you're a smaller company. Oh boy, guys, be ready to have your socks knocked off. Are you ready for stock number 2? Well, here's something for you. It's the most talked about stock in this channel's history, okay? Stock I have a big position in nowadays, okay? Have you guessed what stock it is yet? Yes, you probably have guessed it. GoPro, second worst stock I have ever seen in my time of investing, okay? This stock IPO'd around $24, okay? 4 months later, yes, 4 months later, this stock was trading for $98 a share. $98 a share. I remember they would talk about it almost every day on CNBC. I had friends that would talk about it and whatnot, and I was like, what? This stock is trading at $98? Do anybody have any clue like what's going on with this business? At that time, GoPro had one major product. They weren't in the drone space. They weren't in the virtual reality space. They didn't have nearly as many accessories as they do nowadays. They didn't have a complete software solution. They basically sold action cameras, and this company was trading at $98 a share. It had well over tripled, almost quadrupled from where it IPO'd at, guys. Quadrupled. Unreal. And I was like, is this seriously going on? Is this seriously going on? And it was. And what investors, I think, got caught up in, that were still buying it up in those 70s, 80s, $90 range, and there was a ton of buyers still even in the 60s when it dropped back down, right? What investors kind of were hopeful of is that they can maybe turn into a media company. It's a little harder to do than just, going into a media company, right? Especially when you're a product-focused company. And what happened with GoPro is they did not continue to innovate fast enough. And they went a whole Christmas in 2015 without launching a flagship product, which is an absolute no-no in the electronic space. You've got to launch a flagship product every single year. There's a reason Apple comes out with new iPhones every single year. There's a reason Samsung comes out with new Galaxy phones every single year. Does Apple ever go 1 year without releasing a new iPhone? Nope. Does Samsung ever go 1 year without releasing a new iPhone? Nope. Does DJI ever go 1 year without releasing a new drone? Nope. GoPro went a full year without releasing a camera, and that took sales way down in 2015, which the stock just cratered down, and now we're at a stock that's in the $9 range from $98. It's literally the second worst stock I've ever seen as far as what were people thinking when they were buying in at those $60, $70, $80, $90, guys. Could you imagine the one that actually bought at the highs at $98? Like what were you thinking at that moment? It was a one-trick pony, and I don't know what people were hopeful of, but it was, honestly, it's one of the worst stocks I've ever seen in my time, and I probably won't see very many stocks that bad ever again. All right, guys, the time has come for me to reveal the #1 worst stock I have ever seen in my time. #1 worst stock. This was a stock I held at one point. I held this stock. I bought it originally. It was somewhere around the $8 range, okay? I held it for roughly a year, never made any money out of it, sold out of the position, okay? Over the next year and a half, that stock went from around an $8 stock where I sold out at, never made any money, unfortunately. In a year and a half time, it went up to $43 a share. $43 a share, guys. First off, I was It's probably the worst sell I've ever made because of how much money I could have made in that one, right? This stock, okay, is now a $5 stock. This is now a $5 stock. It was $43, I believe it was 2013, okay? And that stock is Pandora. Pandora, the radio music app that I actually still use this day every once in a while. I'm sure a lot of you guys probably use Pandora out there, right? Pandora, oh my gosh, like I cannot believe this was trading at $43 a share in 2013. Because what you could have seen at that time was when Spotify was gaining more and more popularity, and it was clear that streaming was kind of going to be the future, okay? And Apple, there was a lot of rumors about Apple was going to be entering the space probably within the next year or two, which eventually they ended up doing, okay? And there was rumors that a lot of other places were going to start up streaming services, which Tidal did, and you had all this money, this influx of money coming into a space that was crowding out Pandora. A lot of people that were Pandora users, like myself actually, ended up going onto one of these streaming services and then used Pandora far and far less, okay? Which is what ended up happening to me. I'm an Apple Music user now, and I hardly ever use Pandora. It's pretty rare. I probably use Pandora for maybe 1 hour a week or 2 hours a week, when I used to use it for literally probably 15 to 20 hours a week of listening time. That's a dramatic drop off in the amount of ads, and that happened for Pandora as a company. But that's not just the biggest thing that Pandora had. The biggest thing has to do with actually music royalty rates, okay? So every 4 years, these rates are that Pandora has to pay per song played, right? They generally go up and up depending on how Pandora's business is going. So these rates, they're going to just keep going up as Pandora brings in more money, which then makes Pandora in a situation where it's like they can never make a profit. And if they can never make a profit, and they keep taking losses, they're going to eventually go out of business, guys. And now we see Pandora down here as a $5 stock. And it's like, what is the future of Pandora? The future of Pandora, I'm not 100% sure if they can even, I'm not even 50% sure if they'll even be around a few years from now unless they get bought out by another company because of the type of losses they need to take. And I don't know if I can ever see them making a profit with all these big dogs like Spotify and specifically Apple Music, okay? And you got Google doing their thing in the music game with YouTube and YouTube Red and a lot of different things Google's doing with music. It's hard for me to see a future for Pandora out there unless they get acquired by somebody that can put the money into Pandora, that can say, okay, we'll take losses for the next 5-10 years and then we'll start getting gains after that. I'm not sure that can be there. So seeing Pandora at a $43 stock was just mind-blowing to me, because it was really at that time you could really start seeing that there's all this stuff coming. Back when I was investing in it, it was such a low price stock at $8 a share, and it wasn't clear if streaming was the future at that time. By the next year and a half, it was kind of clear that streaming was going to be the future, and Pandora might not be the future of the streaming. It might actually be Apple Music and Spotify and some of these other guys, which is how it played out. I hope you guys enjoyed this video so much today. I hope this helped you guys out immensely as far as seeing the trends in the future. Don't forget, click that first link in the description. You have a chance to be member 100 over there, guys, in an exclusive group. I would love to have you there. Thank you for watching, guys, and have a great day.